In a market dominated by headlines of skyrocketing tech stocks, it's easy to overlook a sector often labeled as boring: industrials. While they may not offer explosive short-term growth, these companies represent hidden gems for investors focused on a different prize: stable, sustainable dividend income. Here, we'll explore why these ignored stocks can become the cornerstone of a resilient dividend portfolio. So, what exactly are industrial stocks? They are the backbone of the economy. This includes companies in manufacturing, heavy machinery, building materials, logistics, and chemicals. Think of producers of cement, automotive components, or packaging solutions. Their business models are typically mature, stable, and predictable, moving in tandem with general economic growth rather than disruptive leaps. It is precisely these boring characteristics that are their primary strength for dividend investors. Unlike high-growth startups that reinvest every dollar, mature industrial firms have passed their aggressive expansion phase. Their focus shifts to operational efficiency and returning value to shareholders, leading to predictable revenue streams that can support consistent dividend payments over the long term. A key reason for their stability is the presence of a deep economic moat. This term describes a sustainable competitive advantage that is difficult for newcomers to replicate. These moats protect the company from intense competition, allowing them to maintain profit margins and generate the stable cash flow necessary for dividends. Understanding these moats is critical to identifying the strongest players. One part of this moat is economies of scale. Because these firms produce in massive volumes, their per-unit production costs are significantly lower than smaller competitors. Another is their vast distribution network, often built over decades. This established infrastructure allows them to reach customers across the country or even the world, a feat that is incredibly expensive and time-consuming for a new entrant to match. The moat is further deepened by high barriers to entry. Building a new cement plant or chemical factory requires immense capital investment and complex regulatory approvals. Furthermore, many industrial customers face high switching costs. They are often hesitant to change suppliers because it could disrupt their integrated production chains, giving incumbent firms a sticky and reliable customer base. The products and services from the industrial sector are often fundamental to the economy's operation. Offices require steel and cement, factories require machinery, and consumer goods require packaging. While demand may fluctuate with economic cycles, it rarely disappears entirely. This fundamental need translates into more predictable revenue streams year after year, which is a cornerstone of dividend safety. For a stable industrial firm, a routine dividend payment is not a burden. It's a powerful signal to the market. The ability to consistently pay and even increase a dividend demonstrates management's confidence in the company's future earnings. It also proves the business generates real cash, as accounting profits can be manipulated, but dividends are paid from actual cash reserves. Let's move to the practical analysis. The first step is screening. Use a stock screening tool to filter for companies in the industrial, basic materials, or manufacturing sectors. To enhance stability, focus on mid to large cap companies. Crucially, add a filter to only show companies with a consistent dividend payment history of at least the last 3 to 5 years. This narrows your search to viable candidates. Once you have a list, analyze the dividend yield. This is the annual dividend per share divided by the current stock price. A good yield should ideally be above inflation. However, be cautious of an excessively high yield, such as over 8 or 10%. This can be a yield trap, signaling that the stock price has fallen sharply because the market anticipates problems, including a potential dividend cut. Next, examine the Dividend Payout Ratio, or DPR, which is the percentage of net income paid out as dividends. For stable industrial firms, a healthy DPR is typically between 30% and 60%. This indicates the company can comfortably pay its dividend while retaining enough earnings to reinvest in the business. A DPR above 80% is a red flag, suggesting the dividend may not be sustainable. Look beyond a single year's payment and analyze the dividend growth history. The strongest candidates not only pay dividends consistently, but also have a trend of increasing the dividend per share over time. A company that can raise its dividend even during difficult economic periods demonstrates a highly resilient business model and a management team that is truly committed to its shareholders. A safe dividend can only come from a financially healthy company. Start with the balance sheet and check the debt-to-equity ratio. This shows how much a company relies on debt versus its own capital. For capital-intensive industrial sectors, a ratio below 1.0 is generally considered healthy. A lower ratio means the company is less burdened by interest payments and more resilient to financial shocks. Perhaps the most critical metric is free cash flow, or FCF. Remember, dividends are paid from cash, not accounting profit. FCF is the cash left over after a company pays for its operations and capital expenditures. You must ensure the company's FCF is positive, stable, and ideally growing. The total dividend paid should be significantly less than the FCF generated. Now, let's address the risks. The largest is sensitivity to economic cycles. During a recession, construction projects are halted and capital spending is cut, causing revenue for industrial firms to fall. A sharp drop in profits can force a company to cut or suspend its dividend to conserve cash. This cyclical nature is a key risk for any income-focused investor to consider. Stability can become stagnation if a company fails to adapt. Technological disruption, such as new building materials or 3D printing, can erode a once solid economic moat. Additionally, the industrial sector faces intense regulatory and environmental scrutiny. Stricter rules on emissions or waste can require costly investments, reducing the cash available for dividends. Two final risks to watch are commodity volatility and limited growth. Many industrials are heavy consumers of raw materials. A sudden spike in the price of oil or metals can crush their profit margins. Finally, accept the trade-off. The price of stability is often limited capital appreciation. Do not expect these stocks to double in a year. Their value is in the steady income stream. To mitigate these risks, diversification is essential. Balance your industrial holdings with non-cyclical sectors like consumer staples or healthcare. And within the industrial sector, focus on market leaders. They typically have better pricing power and scale to withstand economic challenges. By understanding the risks and performing diligent analysis, you can effectively harness the power of these boring stocks.